What is happening, best ever listeners? This is Matt Faircloth, and welcome to the best ever CRE show, coming at you guys on every Friday. That's it. Every Friday, your buddy Matt's coming here with the best ever CRE show and my segment called Next Level CRE, taking all the stuff you got to the next level. So let's hop in. Let's get to the next level and talk about the elevator getting you to the next level, because our guest today is the author of the book, The Wealth Elevator, and how you can move your net worth up and up and up and up. He gets into talking about some interesting stories in the very beginning of his career, but I want you guys to hear about the mindset that happens once you get into building wealth beyond just the doing side of it and the snowballs that get built for larger and larger investments as you guys work your way up. Before we get inside the best ever toolbox, I've got access to 50,000 people in the toolbox. All of them are in there, and they're at a place called the Best Ever Newsletter. I want you guys to go to bestevercre.com/newsletter. Find out what the buzz is all about. What do all those 50,000 people know that you don't know? Well, you're not going to know till you join the newsletter. Check that out. And if you want to get your message in front of 50,000 plus people, including all the thousands and thousands of people that listen to this podcast, go to bestevercre.com and you guys can hear more about advertising with Best Ever. But first step, go to bestevercre.com/newsletter. Subscribe yourself to the best newsletter out there, the Best Ever newsletter, and you guys can hear what all the buzz is all about. Now let's hop into our interview today by bringing my new friend, Lane Kawaoka, into the studio. Hey, best ever listeners, we're going to bring in our guest right now. Guys, I've got Lane Kawaoka from the Wealth Elevator that's going to talk to us today. And here's what I'm excited about. Lane and I were talking in the green room a little bit. Guys, we're going to talk about what to do when you're an investor, and we're going to talk about what not to do when you're an investor. So Lane, welcome to the Best Ever CRE show. Thanks for joining us and perhaps getting a little bit vulnerable with us today.
Yeah, thanks for having me. Aloha, everybody.
Yeah. Hey, guys. So Lane, you are been an investor for decades in real estate investing. So you've seen the good, the great, maybe the bad, maybe the ugly, man. So let's hop in real quick. I know you were saying there's not enough time to tell your origin story, but I'm just gonna put you on the spot, man. Give it to me in like a couple of minutes of how you got into the space of real estate out there on the beautiful island of Hawaii, where you're at right now.
Give me
the
wasn't always
origin.
here. I was in the cold weather, Seattle, Washington. Went to University of Washington to become an engineer because that's what we're all taught to do, right? Get an engineering degree and work that job. I bought a house to live in because that's what we're brainwashed to do, right? Buy the house to live in. That's what my parents told me to do. So I listened, and I was lucky because I got started with this so early, right? I think it was like barely 21, 22 and already having a house all to myself. And I just started to rent it out. And then bought a duplex a couple years later. And then by 2015, I was doing that turnkey rental thing, right? Buying these things from Seattle, in Birmingham, Atlanta, Indianapolis. So I had 11 rentals by the time 2015 came around. And that was kind of where I was like, maybe I should buy these things that are multifamily apartments. So started to get into that stuff.
Such a logical transition, right? What could it's the same thing, isn't it? Single family home and a multifamily, right?
Yeah. Just do more of the thing that keeps working, right?
I want to comment on a few things. First of all, you've got to be like the 3 or 4th dozen person that is now a real estate investor or just an investor that is a recovering engineer also. I am a recovering engineer myself. I've many, many friends in the space that went to school for engineering. Where'd you go to college?
University of Washington. And I'll add on to that, there's a couple theories I have. First, like, we're not afraid of numbers.
Yep.
I mean, some people are definitely afraid of that stuff. I get it. But
they run the other way.
I think the biggest one is, engineers, you're never going to get rich doing that.
Mm-hmm. Yeah.
So there's a need, there's scarcity.
There is, and I think that a lot of the engineering mindset, the engineering brain of math, numbers, and also, dare I say, solving problems, figuring out systems, right? A lot of that applies to real estate investing. And I also find that engineers in general can think a little bit counterintuitively than the masses, right? So they tend to see the bigger picture, the global scale. They can think about economic shifts and also rent bumps and also how to lower expenses and everything like that. I think the engineering brain is designed to apply a lot of different variables to a system. Right. And that's what real estate investing is, a ginormous equation with 50 dozen variables in it. That's the way to look at it. And that's why I think that our brains work for this business. What do you think?
Also a little antisocial too, right? Like I
Yeah.
don't want to waste my time talking with some general partner I've never met. I'm going to look at the numbers first. What is the
Yeah.
reversion cap rate? What's the increases per year? And then I'll pare it down and talk to the two people that meet the
Yeah.
criteria.
I'm crazy, Lane. I'm the one engineer you'll ever meet that loves people, man. That's why when I got my engineering degree, I got a job in sales. I sold technical equipment that required an engineering degree to be able to explain, but I wanted that people interaction, right? But most engineers I know, you're right, they have an allergy to people, and they just tend to, like, I'd rather just get into the numbers in the spreadsheet and make my decision on that, and I'll just talk to a human being for a minimal amount of time to finalize my decision. So either way, the engineering brain seems to work well in this business. Yeah. So I said we're going to talk the good, the good and the bad, right? So you graduated up from single families into multi, doing a lot of those turnkey rentals, which is an interesting business. It's a good entry point, perhaps a good scaling point. But at some point, you decided you wanted bigger, you wanted more. What was next from there?
Yeah. So, like again, following the logical breadcrumbs, going into
Sure.
multifamily, started to join a bunch of these groups. And I was lucky enough to, I mean, I had some cash back then, but more importantly, I was not married. So I didn't really have to like run these mentorship program pricing across my spouse, right? Because like these things are expensive. I mean,
Just write the check. That's it.
they're
10
like
grand.
double
Here
the
you go.
price these days than it was when I started to get involved in those types of programs. And I would always go to multiple of these things to get, because you always get into one group and you always get this like group think mentality out of there, and they think they're the best. And there's always slightly different groups, some even outside of multifamily apartments, and some outside of even real estate in general. So, but I'm not a totally revolutionary entrepreneur. So I kind of stuck to apartments first as my first operational foray, certainly being a passive investor first in that arena. And first step was, being the engineer, I talked to a lot of people, but it was mainly learning how to underwrite deals myself. And so probably underwrote maybe 100 of them, talked to a bunch of brokers, did that whole dance where you tell them feedback. And so they know that you're actually serious and actually know you're talking about, and not a sucker to just pick up the first 50 deals they send your way, which are just usually just garbage deals. But yeah, that was kind of how I started.
Yeah. Okay. I get it. And so you start to learn the multifamily game. You had done some of the courses that are out there. There's nothing wrong with that. I'll tell you, I'll be straight with you, Lane. The issue that I have with a lot of the gurus and air quote teachers that are out there is those that pose themselves next to Ferraris and giant houses. And it's easy. They present real estate to be a easy get rich quick scheme. Right. And I think that there's a lot of folks that have been duped by it. It is okay to have education. It is okay to pay for education on how to work your way into the space as you would go to college. Unfortunately, up until recently, you couldn't go to college for real estate investing. Now you can. But up until recently, you couldn't do it. So I'm down with the education space. I'm just not down with the gurus, that are selling this thing to be easier than it is. That's my 2 cents. But you did some real estate education stuff on multifamily, sharpened up your saw a little bit, as you said, had to prove yourself to brokers. Love it. What was your first, tell me a bit about that deal, that upgrade deal that was this, portfolio of going from a single family portfolio of turnkeys up into a mid-sized multi. But what was that like?
Yeah. So when you get started, you're not going to get like that nice, shiny Class B or certainly Class A property that's bigger than 200, 300 units, right? So we kind of started, first several years is just these smaller properties under 100 units, more Class C type, so 1960s with the yellow appliances that you change out for the not stainless steel at the time, but halfway decent,
workforce
the black or the
housing,
white ones. But yeah, I think back then, I mean, when you're starting out, it's very typical, buying like a 1960s property, putting maybe $5,000 into it. We weren't buying properties in California or even Phoenix at that time. So prices were a little bit more reasonable out in the Midwest and Texas. So, that was kind of the formula. We got kind of lucky. One of the markets that I was in was more of a tertiary market, Huntsville. I mean, I feel like we got kind of lucky with that particular market.
That market took off, man.
picked a few markets to go into and just started to jump into deals with some new partners. And that was kind of how I just jumped into it.
Got it. So take us down the bad road. At some point, you stepped into a hornet's nest. Talk us through the bad. Give us some, don't pull any punches. Tell us as much of the story as you're able to tell. While understanding that best ever listeners, this is really it's entertain too, of course, but also to teach us all about what to do and what not to do. So take us through.
Yeah. I mean, feel free to ask the questions, Matt. I'm just always sensitive to like, there's somebody out there who is on the other end of this thing, right? But yeah, got into a deal, and as I always tell people, like, you kind of need partners when you're getting going, right? If anything, to sign on the debt with you if your net worth is not already $10 million.
Yeah.
So you need to jump into the deal, if not just for the loan guarantor, key principal side. So and until you're in a partner with somebody, I mean, I think that's the problem. People go to these networking things and they're drinking beers, and maybe I'm just a true up dude, but like, I get along with a lot of people, even though I'm an introverted engineer. And you feel like you know people, and because it's like, wow, Matt, you like real estate stuff that cash flows. We're best friends, right? Because nobody else thinks like that, right? To invest out of the 401k. But it obviously goes beyond that, right? Like there seems to be some synergies in terms of like, hey, we can work like this. You're more of an operator. I'm a visionary, vice versa, whatever. But until you go into a project, and I think in the project on this one, the initial things were just the paperwork. It was nothing crazy. It was just like, when you get into a deal, you have to show draw requests, and you got to, submit to the bank, because normally the bank will hold the operating account, the money, hostage. And because they're trying to protect the deal, making sure you're using the money for the business plan you sought out for in the beginning. And sometimes these banks can be very stringent. Sometimes it can be very easy to submit the supporting documents to get reimbursed. But, the banks there's a range of banks, right? Community banks, large banks, debt funds, and they have different requirements. But I think that was the first chip in the armor, was, just making these real simple submittals at that time. Partners, they didn't know how to do it, and paperwork was not their thing. And I think that was kind of where things kind of fell behind.
What did they do? What did you do? Like, what was their role and what was your role?
I mean, in the beginning there, everybody's kind of hands on deck. But at some point, especially when you have like guys on salary that you're pulling from, because I think that was the problem too. Now that you bring it up, it was a smaller property, so you can't really support people full-time leasing agent. You can't support like a guy on salary, a handyman, mechanic, like you can on a 150 unit or greater. There's a lot smaller property, and therefore to try and cut corners, which I think you should, you try and pull human resources from other assets. And these partners I had, like, that was one of my criteria, is like, I want to work with people who had rental properties and still have, as opposed to sometimes you get into these groups and people come in cold and they've never owned any real estate. They're just entrepreneurs at that point. We all know, if you're on LinkedIn and your tagline is entrepreneur and you don't have a college degree, not saying that that's a huge thing, but like if you're in your 30s and 40s, you just can't find a job, right? And that's also another one of my criteria, especially these days, is like people I work with, I want you to have at least like a Fortune 500, job. Fortune 50, manager, director level job, as I did. Because there was a lot of things I learned, working in corporate America for a Fortune 50 company. Man.
So you're saying that like these folks that are out there that have kind of like been, this is a good word and a bad word. Sometimes I use the word hustle as a good word. Sometimes the word hustle is a bad word. These folks that are out there hustling, that are just kind of going from one opportunity to another, kind of just trying to figure it out, trying to get a check or something like that. Never worked corporate, didn't go to college, didn't get a lot of the education the world has to offer, and maybe didn't get it through the school of hard knocks on their own either, because I got friends that didn't go to college, but they ended up being successful anyway. Maybe got their mortgage brokerage and built up a business or real estate brokerage, whatever it is. They were able to achieve some scale into their 30s. So you're saying that somebody who's really not able to get much traction out of life so far.
Yeah, not even in real estate, right?
Anything.
And I'm not a huge fan of college either, but like you said there, I mean, you need to have some type of track record, especially for the guys who haven't really proven it elsewhere.
Show me success somewhere in your life, right? This is partner vetting 101, best ever listeners, right? And Joe Fairless, I don't know if I agree with him on this one or not. I love Joe, but I don't know if I agree with him. He said that you can't partner with anyone who has not done what you're asking them to do in your company for someone else. Right. So you can't have a partner that is running your ops who has not been an ops manager before, or has not run acquisitions or underwriting or whatever it is. Interesting. But at some point people have to, I guess what Joe is saying, you don't ever want to be somebody's first, sometimes there's got to be a first. I think you got to just see the effort.
I got employees, and I think that's certainly a range too for employees, right? Like you never want to hire up, somebody based off potential. I think when it's employees, I think it's a little bit more stringent, but I think I'm on the same page as you. As partners, sometimes to get the right deal economics, you may have to lead in a way, like how you're saying. Like, I mean, like passive investors make this mistake all the time. They try and find a new operator to work with, or I guess not even an emerging operator, but just somebody who has zero track record, because they want an 85-15 split or a 90-10 split. I think that's the silliest thing. I think, obviously you don't want to work with an institution, people that have $5 billion, $10 billion of assets if you're going to get a 50-50 split. I'm just speaking for the people listening as more retail investors. There's a nice sweet spot in the middle as a middle market operator, somebody who's done $1 billion, $2 billion of assets. And I think there's a sweet spot there. But, people are welcome to argue, I guess.
More than welcome. We'll give Landy his email address at the end of this episode, so you guys can send him your arguments, right? No, I'm just kidding. I'm not going to argue with you. So you've got this person, not sure, maybe was not a good partner fit. You ended up getting into a deal. They were submitting documents, as you had said, to the bank. Were they also the key principal? Was someone who had higher net worth,
Yes.
Or were you the key principal?
Yeah, at the time, not all of us were really rocking in terms of personal net worth. So it was, there was a bunch of us as the key principal.
You had to add it all up.
Yeah,
Right.
to add it all up. Luckily, it wasn't that big of a deal. I think the loan side was less than 5 or 8 million, something like that. So when you're buying properties on that scale, 3 or 4 guys could probably take it out, right, with $1 million each.
Right.
But yeah, I would say at that point, just the paperwork wasn't getting done, and then the spidey senses go off, and then you're starting to see, charges here, staff, and it's like, well, this is just way too easy to, kind of commingle things, and as a fiduciary to investors, right? Like the next step was to obviously remove them as a partner. But then now you have to read the operating agreement, like figure out how you can do that and on what grounds to do that. Specifically, like some PPMs are very liberal for the general partner, and it has to be like they had to go to jail or be convicted of a crime, right, to do that. Some are like, well, I think for us it was a little, we were kind of lucky there. The operating agreement was written sort of in our favor in that way, where just simply duties weren't getting done and we could cite those things. And at the same time, sometimes that can leave a general partner open for a LP mutiny on their hands. But in that case, it actually helped us as sort of GP activists in that case. I mean, we just wanted what was best for the LPs, right? Sure. I mean, that was where we lived and died too.
Yeah. Yeah. I got to tell you that you're one of the many folks I've talked to that did not read the operating agreement until there was a problem. And that I'm in my earlier stages in real estate investing, I had the same boat. Like I was trying to exit with a partner, and unfortunately, my operating agreement was very vague, and didn't have any type of straight exit clauses. So, best ever listeners, if you guys are entering a new partnership, or if you're even considering investing in something, read it. Read the operating agreement. Your financial future could depend on it. So read this and make sure there's some carve outs in there. So you did have carve outs to remove this partner that, as you said, you alluded that maybe with some commingling of funds, maybe inflating of invoices, maybe a little bit of fleecing going on. Did you like overnight drop the bomb? Okay, you're out. Accounts are now out of your name. That kind of thing. Like, how do you handle an exit like that?
Yeah, I mean, for the most part, a lot of that is unverifiable, right? It just the major grounds was you're not doing your job, right?
Yeah.
Like we're eating into working capital, and working capital is you're not going to pay the invoices right away, and there's always this uncomfortable time when the bank reimburses you for the work that you did because they need to see proof that you did the work, and just that paperwork wasn't really getting done there. So, I guess if I recall, I mean, that's why you just bring in the lawyer, right? Like that's what lawyers are for, because they have to kind of, as we mentioned before, you have the initial reason behind it. You check the operating agreement, but then it's like now you're kind of in the street fight, right? How do you actually implement this damn thing?
Yeah.
You get votes. You typically have to get votes, right?
Yeah.
Either from your GP side, but if you don't have a 51% or more, typically sometimes it's super majority, and that can be extremely difficult. And that's why I wouldn't really, in most cases, I don't really like super majority. I like just the straight up majority. But then you can also go, we had it written where we can also go to the LPs and invoke the LPs to vote the right way. So if I recall, we did a like a virtual meeting, thank goodness. But the legal team I do think that they were, I mean, it was kind of set up like it was in person, but it was done virtually, and then investors were able to put proxy votes in either through email. Thankfully, we weren't able, and this would be a suggestion, is like you never want to have it follow the true formalities of like paper ballots, registered mail to everyone, because that's just too costly. And you obviously get on the phone with every single person and kind of tell them what's happening. But, when you have all these barriers, like you have to lick a stamp, write the right form, get the form to them.
Yeah.
It's just like, it's hard to just, moving a ship here to do that, to do the right thing. But yeah, we got over the hump. Everything was recorded. The big thing here is like the control of bank accounts. Right? That was the big things, because I'm not gonna say whether this person is bad or good, right? But after when things go astray, even empathetically from their side, right? Like maybe they thought everything was kosher on their side, but they can think that we were the ones being the pirates taking over the ship, right?
Yeah.
People are people, and they can do crazy things, and on the way out. So
this
that's
sounds like
why
they just weren't a good fit for the seat that they were in. I mean, I'm not one that believes that all people are absolutely terrible and evil or whatever it is. That I just think that's just the wrong fit. And maybe people taking advantage sometimes too. That is possible. But did you engage them personally? How did they take it after? Did they cleanly exit and just walk out the door? Did they try and fight? Like, how did the interaction with them directly go?
I mean, my tactic. I mean, I'm not super unempathetic or can't read the room. So if I recall, I think I let the lawyers primarily drive the ship. Because my theory is, once you have like quarrels come up, if you're a person who has any type of backbone, you're gonna get adversarial, right? Like if you have, like, people have been through divorces, right? I think I use that as an example as a very emotional time for both parties. You typically have a situation where one person says, "You're gonna get this," or "I'm gonna get you this." And then the other person is going to say no. And then the first person says no. And then once you have that standoff, it's like no go for anything, right? Same goes for these types of situations here. So I would say, like, if you can avoid that at all possible, like I guess they call those stalemates, right?
Yeah.
Or I'm a loss for what's the Gottman, one of the four horsemen, stonewalling, right? Like once you get into that situation, in any negotiation or any quarrel, like it's done, right? It's just going to go. The lawyers are the winners at that point, as they say
They get the
in
fees.
a divorce. So, I mean,
did your former partner lawyer up too? Did they try and throw lawyers at you guys to try and save their position, or did they just?
And then once people bring in lawyers, right, you're not supposed to like really talk to, you gotta let them talk, right? Which actually might be a good thing at the end of the day. Of course, the danger is if they get a silly lawyer that doesn't really know what they're talking about. They start to talk about securities law, and they're just a regular estate attorney lawyer, which is kind of the bottom of the rung.
Just throwing rocks. Yeah.
So, and then they're just trying to milk their client for more hours, and that's really the game that they're playing inside. So that's the issue that sometimes you run into, especially when with less experienced operators finding these like lower quality lawyers out there. But to answer your question, your earlier question, I mean, usually just let the lawyers run the ship at that point, because
somehow or other your partner
take the human element out of it, right?
Yeah, your partner took an exit, so they're gone. They fought a little bit with lawyers and that kind of thing, but you're able to get them out of the deal. How'd you bring the deal around? Like, so then what, right? Now there's there's someone that was doing something in the company that's now gone. You and the other partners now need to figure out how you're going to bring this property around to, or not, right? For investors. What did you do and what was the result?
Well, that's the boring part, right? Like when we got a new property manager in there, change the bank accounts around. I mean, honestly, I don't even remember too much. I mean, I remember it was a bit of a struggle to get that thing turned around because it was such a smaller property, and it was hard to find a property manager that would run such a small asset, because when you're around 50 units to 100 units or less, the good commercial guys who you're going to charge, the 3.5% leasing fee on is just not going to want to touch that. And then then you're dealing with these residential property managers, and that's a huge hit and miss, right? A lot of them are working with mom and pop investors, and the biggest thing there is they're using third party repair people, right? So like if you have a plumbing repair, you're going to pay $900 to fix that toilet, whereas if you have a guy on staff, I mean, it's pretty much engulfed in their salary before their first smoke break out of the day.
Yeah, and they'll have it knocked out. Yeah, one of my best investments was a maintenance repair tech that worked for my company, and also I went out and bought one of those snakes that the Roto-Rooter uses, right? So I went and bought one of those, like a 100-foot snake, and I had a dude that knew how to use it, and that saved me every time you had a toilet clog. Back in those days, probably $300, $400 to get a toilet unclogged, when you could just, he could just knock it out, like you said, half an hour of his time maybe. So you were able to, what was the end game with the asset? Do you still own it? Did you end up selling it? What did you end up doing?
We sold it. I mean, once you get to that point, I think the another bad thing that happened on that one, maybe another lesson learned, is we bought it with this special tax treatment on the entrance. I think it had some type of like religious affiliates. I think people will identify or understand that, like, it was under some type of special treatment. Basically, when we took over it, sometimes these kind of things go good or bad. It's binary, right? It went bad for us, so we lost that tax treatment. So, people who understand how powerful that net operating income divided by cap rate market value equation is, when now you have to absorb an extra, $10,000-$20,000 of taxes a year or more, that equates to like, shoot, we just lost like $1 million with that thing in terms of net evaluation at the end. So, with that and kind of that slow rocky start in the beginning, it was just like, the analogy that sometimes we use is like, well, we're just trying to bring this plane back to Earth, right? Or like I use the Apollo 13 analogy of, when they had that big explosion on Apollo 13, they're like, we're not bringing, guys, gentlemen, you're not going to the moon anymore. We're just trying to bring you boys back. Right.
Yeah.
So that was the situation on that one. Nobody lost money. Thankfully, actually, I think we made money. Maybe made like a 20, 30%, or 20%. I don't know.
Better than sharp
all
chicken
in all,
in the
it was
eye.
like,
That's great.
You run into all these problems, and again, it wasn't, those were the hardest properties to run, those smaller properties and the Class C properties, because you get 4 units that just happen to go vacant. Shoot, that was like you went from 92% down to 84%, or 82%.
Cash flow.
Yeah, and you have these huge swings because it's a small property. So all in all, I mean, lesson learned. Luckily, we made a little bit money, and that's in the bigger grand scheme of things, I've worked with a lot of partners, and the gift, to look at things optimistically is like, well, now I know not to work with that person again.
Well, yeah, you knew that, right? So now there's that, like, let's transition, right? So that property's been sold, 20, 30% return on investment's actually not that bad of a story. It sounds like you just got a good lesson from your prior partner, right? What you and that eventually pivoted into, some paper assets, and other investment vehicles now. So as we bring things home, tell me what you learned from this, bottom line, and how you carry that into your future and what you're up to now.
Yeah. So, I mean, we were lucky enough to get established before 2020. I think 2020 is when we went over $1 billion of assets, but also then, we were active in the peak of the market, right? And got hurt just like everybody else. If they're saying they aren't, they're lying. Like, I mean, so if people don't want to talk to me for that because we haven't gone through trials and tribulations. I probably don't want you as an investor either. I prefer to like investors who've been through a couple of market cycles nowadays, because, this is investing. I mean, things change over time. Like those little turnkey rentals I would buy pre 2000, 2010 to 2015 in that little era right there. I would buy them from 80 grand and now it's 120 grand. Like, you cannot make those numbers work today. So the saying is, what got you here isn't going to get you there. And then for me, it's like these apartments, and we had some great exits. But with interest rates high, I mean, it's very difficult. And you combo that with taxes and insurance pretty much doubled since when we got started into it. Sometimes some of our properties that we bought in like Mississippi, for example, prior to I think we bought some of those in 2018. We saw the insurance triple on us, and it was going to quadruple. We knew damn right. And so we got out of them. But I think that's the nice thing about multifamily real estate, is that it's something that you can just hire a property manager. I mean, I'm being real simplistic with this. Hire a property manager, and if you have a good enough asset, the ship will sail on its own. But the problem is when real estate evaluations go down 20 to 30%, like we did, there's not much levers that you can pull.
Yeah.
Right. It's not like buying an operational business, right? Like from a P&L standpoint, like there's not much you can do if you're in a softer market and you can't really push past 92% occupancy. Like, I think some inexperienced investors say, well, just lower the damn rents. Well, that's a race to the bottom, sir.
Sure.
Like, trust me, we've tried that from time to time and gotten a little desperate. But when you do that, you drop your rents and it's a race to the bottom. And then you start to bring in these crappy tenants that trash your property 6 months from now, and your community suffers. And in the long run, unless you're going to sell the property in 3 to 6 months, that's a really, really bad idea to do that, to go for the short term. But yeah,
let me hop in and ask you. I want to ask you a question here. You said this was a mid-sized property. Somehow or another, you got to $1 billion, right? Like that was a big jump. I wanted to just highlight that, right? I think in your underwriting here, it says in your bio, it says you were at $2 billion at one point. Was that all multifamily assets of $2 billion of assets under management, or was that different types of asset classes?
Mostly multifamily. So what happened is, and I think, operators understand the law of the first deals, I would say. like that, those first sets of properties went really well. And we started to get a lot of notoriety, especially in the broker community. And then we kind of hit our stride right around the pandemic, 2020. That was kind of when we hit that big amount. And we started to hire people who are much better than us to operate, started to headhunt other operators. And but the brokers kept getting us deal. I think part of it was like big institutions kind of pulled back a little bit, maybe for 3 to 6 months in the pandemic. It was scary times, right? We kind of pushed through, and we actually got a couple of nice exits coming up from properties bought in that little pocket, that summer of the pandemic season.
Yeah.
There. And that, when the brokers, whether right or wrong, when they see people who are having success or closing deals, they feed you. They feed the hot hand, right? Because brokers want to close the deal. They want to work with proven closers. So I guess we were those people. So that kind of launched us past the $1 billion acquisition mark at that point. That was also when we started to get involved in the preferred equity paper side, I guess you would call that, kind of acting as debt too. So a minority chunk of that 2 billion acquisitions today is some hotels too. But that just came around through, relationships.
How do you like the hotel
I had
world?
actually tested previously. So
yeah.
I think that's kind of like, people ask like, well, what's the criteria today? It's like, well, the criteria is first people. I mean, if you have a good deal, you can typically navigate out of it, especially if it's real estate and the numbers work on the front end, you underwrite it well. Things always go wrong, as they say, if you have an incompetent operator and you have a dishonest operator, right? Because those are the two things. When you're doing due diligence on an operator, as we do, you need to figure out, is this person competent? But the biggest thing is, you can have a competent operator, but if they're unethical and dishonest, then that's gonna muddy the water all the way around.
Yeah. It's all about who's doing the work. So you're directing capital into other people's, like, you're not fully integrated where you're running the operations side too. I think, right, smartly, you're running a capital raising and direction company that's directing it into seasoned operators that you like and trust.
If we go outside of real estate, if it's real estate, we operate it. It's our home cooking and our developments.
Okay.
Right? So that was kind of where I realized, like, I got really hurt this past correction, because like 90% of my personal net worth, maybe even more, was in commercial real estate. And yes, that's what got me here. And people who are first generation multimillionaires will typically agree that concentration, watch that basket like a hawk theory, is what gets you to the game, right? Gets you to 7 figures, multiple 7 figures and above. But then now I realize, maybe it would have been nice to have some things outside of real estate. And now a lot of like my journey has been just like how I followed all these other cats to multifamily investing. I followed a lot of those people have grown up with me, and used to be going to these same seminars in 2016, 2015, and now are branching off to buying businesses, business acquisitions, private credit, those types of investments. And some even, angel investments too. I'm part of the local angel group here, just for kicks, did a couple investments in that world just to kind of understand it. That's how you learn. If it, no different than a turnkey rental, 15 years ago or something like that for me. And, today I learned by doing. And I truly believe that, especially now with interest rates high, as Howard Marks said, like we're coming out of an era of free money, and that's not going to be happening anytime soon. You look at the Chatham financial curve that forecasts interest rates. The Fed rate's not going to come under 3% in the next decade. It appears.
Probably shouldn't. We probably should stay up there. I'm not sure if it was a good thing that you could borrow money so cheaply. It probably forced a lot of bad decisions in that. But hey, bringing it home here, you are what I would almost involved in a lot of different things, angel investing and all that. You're in the I quadrant, Kiyosaki 101, where, the ESBI, right? So business owner and investor. So I see that you're really living, healthily in the I quadrant of where you're making your money, right? What advice do you have for best ever listeners that are looking to make more and more of their money through their investing, through passive income versus through their blood, sweat, and tears? Like bring us home with any final advice you got.
Well, I mean, I think first thing is a prerequisite. If you are under $1.5 million, $2 million net worth, you gotta still get after it and be the operator. Yep. I think that's the B quadrant, right? Whether that's in real estate or a lot of the investors that I work with today have created some pretty successful businesses. Maybe not huge, but if they sold it, they could get anywhere from $2 to $10 million. That's not too shabby.
No.
If you aren't, then you're not there yet, right? Like it's just math. Like in my book, The Wealth Elevator, we define these kind of floors to the wealth elevator. I think we're kind of talking about floor 3, right? When you're getting to this kind of level of $4 to $5 million net worth, where if you wanted to, you could just put your money in life insurance or T-bills and T-bill and chill at that point at the 4% rule, right? Now, obviously, that's not what we're going to do, especially listeners here, but you could. And until you get to that point, you can't really act like a family office. Like a family office is what most people know as family that has $100 million net worth or greater. I would actually disagree. I would say you can be a family office as long as your primary goal is to be a good steward of your money and invest it, as opposed to trade time for money in a business. So that threshold could be $2 million. It could be $100 million, right? So I think that switch in your head you need to identify if you have enough money to basically do that, because you can't just be a passive investor and be broke. That just doesn't work. But I think there's some self-awareness test in here first.
You have to work through the hurdles to get to the different levels, and then to build your wealth up to the point where you can then put it to work. Tell us a little bit about your book, The Wealth Elevator. That is a book that I think best ever listeners should check out to hear what floors that they're on and everything like that. Tell us a bit about that book and what folks could expect to get from it.
Yeah, the main thing in the book is there's a chart in there that kind of breaks down these different floors of the wealth elevator. We don't talk about the basement level, the guys under $50,000 in income a year or under $250,000 in net worth, right? Like I think that's majority of books out there, and great books, right? The Susie Ormans, Dave Ramsey, maybe even the Rich Dad Poor Dad, right? I think the Rich Dad Poor Dads are mainly focused towards guys who don't really have too much money.
Well, I think Rich Dad Poor Dad, I think is about the existence of an elevator, in that like, hey, you don't have to, trade hours for dollars with your job. There is this mechanism over here called investing, called building wealth, called buying assets. So, but yeah, I get it. So folks, the wealth elevator is really about, once you're aware that there is a path to financial freedom that's maybe outside of a day job, check this out.
Like, and you have the capacity to do it, right? I mean, to me, the elevator starts when you have a accredited investor status. Yeah. Right. $1 million net worth or greater, or you're making pretty multiple 6 figures of income. And I think the epiphany happens is like, well, where is that point where I go from the second floor to the third floor, which is somewhere around $4 to $5 million net worth, and then where do I go from there?
Yeah. That's great. Well, folks should check it out. How do folks get a copy of that book? How do they reach out to you to hear more about all the things that you're up to?
Yeah, so they can go on Amazon. It's not too expensive. But I guess we always want to give like a free gift for people making this far to the podcast. But yeah, if they buy it, they show maybe a receipt or something like that, or a screenshot. Email team@thewealthelevator.com. We'll hook them up with the PDF and then the MP3 version if they're not a good reader. Just
there
like
you
I'm not a good reader.
Get the electronic version too. Guys, go check out thewealthelevator.com to hook up with my new friend here, Lane Kawaoka, and hear about the wealth. At what wealth elevator position are you guys in? Find out what should you aim to get to next. Find out with the Wealth Elevator book. Lane, thank you for joining us on the Best Ever CRE show. I really appreciate your time and some inspiring stories today. Guys, great interview with Lane Kawaoka. I really enjoyed the concept of the Wealth Elevator. Hope you guys check out his book and think about ways that you guys can bring yourself, your investors, your investing stages up to the next level. I like that idea of elevation using an elevator concept because there's things that are relevant at the first couple floors and that are maybe become irrelevant as you move your way up an elevator and that. So maybe what's relevant to you now to get to the next level, and things that you don't have to worry about till later. Maybe you don't have to worry about whole life insurance or deeds of trust or all kinds of other wacky stuff or living trust that people do when they achieve different levels of wealth status. Maybe just get yourself to the next level and worry about what there is to do at the next level beyond that. I like that concept, and I'm going to be thinking more about it for my business and my investing strategies. I hope you guys do the same too. Until then, guys, come see me on Fridays here. Make sure you like this podcast. Make sure you subscribe to this show and share it with a friend for those that might want to build their wealth alongside you, with you, as part of your little network of other wealth building friends here on the Best Ever community. Until then, guys, come see me next Friday and join all the other podcast hosts here on the Best Ever network as well. Until then, guys, thanks for listening and have a best ever day.